Welcome to the Deep Dive. We're the show that really tries to pull out the key insights from, well, sometimes a whole stack of sources.
That's the goal.
And today we're tackling one of finance's big ones. I mean, really enduring and frankly, pretty perplexing questions. Why do some stocks just, consistently do better or worse than others? They seem to stubbornly defy these, well, elegant theories we've
Oh,
built.
right, the models that should explain them.
Exactly. And for decades, this has been a central battleground, a huge landscape of what the field calls market anomalies. It's kind of pitted the rational world of efficient markets against this more unpredictable realm of behavioral finance.
A real academic tug of war.
Think about it. The traditional models, like the classic capital asset pricing model, CAPM, they basically suggest higher risk should always mean higher expected returns. Simple. Well,
Seems logical.
but then you see things like value stocks, companies that seem cheap compared to their assets, consistently beating growth stocks over long stretches. Or momentum, where stocks that have done well recently just keep doing well. These are the kinds of surprising facts, as our source calls them, that just don't fit neatly into those old boxes.
Yeah, they really mess with the neat picture.
So our mission today is to dive deep into a powerful new perspective, one that offers a neoclassical, so rational explanation for a lot of these market puzzles. It could potentially revolutionize how we think about stock returns.
A big claim.
It is. We're talking about the investment CAPM. And this approach, it fundamentally shifts our focus away from purely investor behavior, that's the demand side,
Right, what investors want.
to the actual, real, and importantly, rational investment decisions made by firms themselves, the supply side.
Bringing the companies back into the picture.
Precisely. And guiding us on this, let's say, intricate journey is a really comprehensive review article. It's from 2017 by Lu Zhang, and it's perfectly titled The Investment CAPM.
A cornerstone piece, really.
Yeah, it pulls together years of foundational research, tons of empirical evidence. It gives us a solid framework to understand this, well, fascinating counter-revolution in finance.
And it's important, to start by appreciating the brilliance of those initial theories. You mentioned the original CAPM, pioneered by Traynor, Sharp, Lintner, Mawson, the big names.
Legends.
Absolutely. And its theoretical descendant, the consumption CAPM from Rubenstein, Lucas, Breeden, these models are just conceptually so elegant.
You really were.
They aim to explain how risk relates to expected returns, but primarily from the investor's demand side.
Yeah.
They focused on how we as individuals, with our preferences for consuming now versus later, and our aversion to risk, how we'd allocate our capital.
Makes sense.
The consumption CAPM especially tried to connect stock returns to how sensitive they were to changes in overall economic consumption. The idea was investors would demand higher returns for assets that tank right when everyone's feeling the pinch, cutting back.
Yeah, that sounds perfectly logical on paper. I mean, if a stock tends to drop just when everyone's tightening their belts, you definitely want a bigger reward for holding on to it.
Exactly.
But this theoretical beauty, especially for the consumption CAPM, it really hit a wall in the real world, didn't it? Our sources call it an empirical failure. It just couldn't explain the actual returns we see. Why was that?
Precisely. Despite the theoretical appeal, when researchers actually tried to test the consumption CAPM with real-world data,
Yeah.
the results were just consistently disappointing. The model simply couldn't account for the risk-return relationships people were observing in the markets. So this widespread empirical struggle, it left a big vacuum in our understanding. A lot of patterns just weren't explained.
And into that vacuum surged what became known as the anomalies literature. You mentioned this started way back, like 1968 with Ball and Brown.
Yeah, that's one of the early landmark studies.
And it just kept growing. Researchers started documenting all these persistent patterns in stock returns that the consumption CAPM and even the original CAPM just utterly failed to explain. And these weren't just minor blips, right? They were these surprising facts showing certain types of firms consistently earned higher or lower returns than any of these demand-side models predicted. What kinds of patterns are we talking about here specifically?
Yeah, these anomalies really did challenge the status quo. One of the big ones was the value premium. That's where stocks with low price-to-book ratios, often mature, stable companies, kind of boring maybe.
Yeah, the unloved ones.
Right. They tended to outperform growth stocks, which had high price-to-book ratios, often tech companies, seen as having huge future potential. The classic models just struggled to explain why this value characteristic consistently paid more on average.
Okay, so value was one.
Then there was momentum. Stocks that had performed well in the recent past, say, last 6 to 12 months, just kept performing well, and past losers kept losing.
The winners keep winning, losers keep losing.
Exactly. And these weren't isolated incidents. They were robust or repeatable patterns. You saw them in different markets, different time periods. It made them really difficult to just dismiss as, noise.
So with the traditional neoclassical models hitting these empirical roadblocks, something had to give. And what emerged was behavioral finance, offering a completely different kind of explanation.
Indeed. Behavioral finance really rose to prominence by saying, look, these anomalies aren't about rational economics, they're about investor psychology.
The human quirks.
Exactly. It suggested that our biases, our cognitive errors, our emotional responses, they lead to mispricing in markets that aren't perfectly efficient.
Yeah.
Concepts like overreaction, underreaction, conservatism, self-attribution bias.
All the ways our brains trick us.
Right. They were used to explain why investors might systematically overpay for glamorous stocks or undervalue boring ones, letting these anomalous return patterns stick around. And this created a real divide. On one side, neoclassical economists holding on to rationality. On the other, behavioralists arguing for the huge influence of human irrationality.
Okay, let's unpack this. Because the debate has been fierce, right? It really defined finance for decades. You had these two titans clashing, these elegant, rational models that couldn't quite explain the data, and the psychologically rich behavioral models that offered explanations, but maybe sometimes felt a bit less rigorous on the fundamental economic grounding.
That's a fair characterization.
But our deep dive today suggests a profound shift in perspective. And here's where it gets really interesting. Enter the investment CAPM, or ICAPM. Zhang calls it a counter-revolution.
And this counter-revolution is fascinating because it's a neoclassical alternative. It's coming from the rational camp.
Right.
Instead of blaming irrational investors, the investment CAPM argues that these so-called anomalies are not signs of mispricing or irrationality at all. Rather, they are logical, rational consequences of firms' real investment decisions. It brings the supply side of the economy, the choices companies make about building factories, developing products, how much to invest, back to the forefront of asset pricing. It's a return to first principles, but viewed from the company's perspective.
So it's like saying, hey, maybe the problem isn't that investors are acting weird, but maybe we just weren't looking at the right fundamental economic drivers, the ones connected back to the companies themselves. That's a huge conceptual pivot. It totally reframes the question.
Exactly. The ICAPM is built on this fundamental economic principle. Firms, like any rational agent, make investment decisions to maximize their market value. It's a cornerstone of corporate finance, right? The net present value rule.
NPV, yeah. Everyone learns that.
So let's think about a simplified model for a second. A firm decides how much to invest by balancing the marginal costs of that investment against its marginal benefits.
Marginal cost, that seems pretty straightforward. The actual purchase price of new equipment, building a factory, plus maybe some adjustment costs like retraining workers or disrupting production?
Correct. The cost of putting that new capital to work. And the marginal benefits, that's the present value of the marginal product of capital.
Okay, translate that.
Basically, the future operating profits that extra unit of capital is expected to generate, discounted back to today. So a company keeps investing, keeps adding capital, right up to the point where the additional cost of that next unit of capital is exactly matched by the discounted future profits it expects to get from it.
Right.
This fundamental economic balancing act is what links their decisions directly to how their stocks should perform.
So using your factory analogy, if building an extra wing costs, say, $10 million today, the company only does it if the discounted future profits from that wing are expected to be at least $10 million. They're making a purely rational decision based on maximizing shareholder value.
Precisely. And what the investment CAPM then does, the crucial step, is connect these firm-level investment decisions directly to expected stock returns. It predicts that expected returns will vary systematically across firms based on their investment and profitability characteristics.
Okay.
And this gives us two critical predictions, the investment premium and the profitability premium.
All right, let's start with the investment premium. The model predicts that, all else equal, high investment stocks should earn lower expected returns than low investment stocks. Now, that seems counterintuitive at first glance. Wouldn't a company investing a lot be growing, maybe more attractive, suggesting higher returns?
It's a common initial thought, yeah,
Yeah.
but the intuition is actually quite elegant when you think about the firm's decision.
Okay, walk me through it.
If a firm is making really high investments, it must be because the cost of capital, the discount rate it's using for those future profits, is low enough to make those investments look good to give them a positive net present value. If the cost of capital were high, the NPV of new projects would be low or negative, and the firm would rationally choose to invest less. Therefore, firms with high investment must implicitly have a lower cost of capital,
And a lower cost of capital means.
lower expected returns for their stockholders. It flips the thinking, doesn't it? High growth from investment isn't automatically a sign of high future returns. It's often a consequence of having cheap capital available.
That makes perfect sense now. It's not about growth for growth's sake. It's about the economic cost of achieving that growth. Okay, so that's the investment premium. Then we have the profitability premium. What does the ICAPM say there?
So conversely, the model predicts that stocks with high expected profitability should earn higher expected returns than stocks with low expected profitability. But you have to control for their investment levels.
Controlling for investment. Okay, why?
The intuition here is just as profound, really. If a firm has very high expected profitability, it's making great margins, things look good, but it's not investing much. Well, why not?
Good question.
It must be because the discount rate, the expected return required by investors, is high enough to offset that great profitability.
This high discount rate makes the NPV of new potential projects look low, discouraging more investment despite the high intrinsic profitability.
So high profits but low investment signals a high hurdle rate, a high required return.
Exactly. If the discount rate wasn't high enough, the firm would see these amazing NPV projects everywhere and would be investing like crazy. The lack of investment, given high profitability, implies a high discount rate.
What's fascinating here is, like you said, these predictions, they aren't just pulled out of thin air or based on just watching correlations. They come straight from the net present value rule, a cornerstone of corporate finance, just applied systematically to asset pricing. It's tying market behavior back to fundamental, rational business decisions.
Right. And this is where you really start to feel the power of this neoclassical approach.
Yeah.
It's grounding asset pricing in the optimizing behavior of firms.
Yep.
And it's important to note a key theoretical point here. In a full general equilibrium model, the consumption CAPM and the investment CAPM are actually theoretically two sides of the same coin. Researchers like Lin and Zhang showed this. They should deliver identical expected returns in theory.
Okay, so theoretically they're equivalent.
Yes, which makes the next part even more interesting. Why does one perform so much better in practice? The investment CAPM just seems to offer a more empirically tractable way, the more direct way to connect those fundamental economic decisions to asset prices we observe.
Okay, so I have this elegant theory, the ICAPM, but, the proof is in the pudding. How do you actually put it to work? Does it actually explain things in the real world? And that's where the Q factor model comes in, right? Giving us the empirical muscle.
That's exactly right. Hu, Xu, and Zhang, in their 2015 paper, developed the Q factor model. This is the empirical powerhouse for the investment CAPM. Think of factor models generally as tools trying to capture common sources of risk or return in the market using just a few observable characteristics.
Like recipes for returns.
Kind of, yeah. The Q factor model aims to explain that cross-section of expected stock returns, why some stocks have higher average returns than others, using several key factors derived from the theory.
And what are these 4 pillars, as the outline calls them, of the Q factor model? What makes it tick?
Okay, so first you have the market factor, MKT. That's pretty standard, included to anchor the overall average return of the market, just like in other factor models.
The tide that lifts all boats, sort of?
Exactly. Then there's the size factor, ME.
Yeah.
Small cap versus large cap stocks. Now, size has been a popular factor for ages, especially for evaluating mutual funds.
Yeah, the small firm effect.
But Ho et al. Show that its incremental role in explaining a broad set of anomalies is actually pretty minimal once you have the other Q factors in there.
Interesting. So less about explaining the big puzzles and maybe more about practical stuff like fund evaluation in this framework.
Precisely. The real core, though, comes from the 2 factors directly derived from the investment CAPM's predictions we just talked about. First, the investment factor, IA. This is measured as the annual change in a firm's total assets, divided by its total assets from a year ago. It directly captures that investment premium idea that high investment firms should have lower expected returns.
Got it. And the second core factor.
That would be the profitability factor, ROE. This is measured using quarterly earnings, specifically income before extraordinary items, divided by the book equity from the previous quarter. This factor directly captures the profitability premium. It predicts that high profitability firms controlling for investment should earn higher expected returns.
So you've got market, size, investment, IA, and profitability, ROE. These four factors together, they get put to the test against the existing models like Fulma French 3-factor and Carhart 4-factor. And this is where the Q-factor model really starts to pull ahead, right? The empirical results are pretty striking.
They really are compelling. Across a wide range of these market puzzles, the paper looked at 35 different significant patterns. Grouping stocks by characteristics, the Q-factor model just left astonishingly little unexplained. Its average unexplained return, the alpha, was only 0.2% per month.
0.2%? That sounds tiny. How does that compare?
It's dramatically lower than the Carhart model's 0.33% alpha and the Fulma French 3-factor model's 0.55% alpha.
Wow. So that's a huge difference in what the model can explain. It means it's doing a much, much better job capturing these returns.
Absolutely. And maybe even more importantly, it successfully explained almost all of these puzzles. Only 5 out of the 35 anomalies were left statistically significant, unexplained by the Q model. Compare that to 19 unexplained anomalies for the Carhart model, or a staggering 27 left by the Fulma French 3-factor model.
27. So the old standard was leaving most of these puzzles unsolved.
Pretty much. This wasn't just a small improvement. It suggests a real shift in how well we can understand why stocks move the way they do based on fundamentals. The Q model also had the lowest average absolute alpha across all these test portfolios. Even the really tough Gibbons, Ross, and Shanken test, the GRS test, which checks if all the alphas are jointly zero, it rejected the Q-factor model in far fewer cases than the others.
Okay, strong statistical backing. And what about momentum? That's always been a really tricky one, often claimed by behavioral finance. How did the Q-factor model handle that?
Even for momentum, which is notoriously difficult, the Q-factor model showed superior performance. Its average alpha for the high minus low momentum portfolio was 0.19%. That's way lower than Carhart's 0.29%, and especially Fulma French 3-factor's 0.85%.
0.85. So the basic Fulma French model really couldn't explain momentum at all.
Not really, no. This shows the Q-factor model provides a much better, more rational explanation, even for this long-standing puzzle.
So what does this all mean for you, the listener? It means the Q-factor model is doing a significantly better job explaining these anomalies, these market patterns that used to stump everyone. It's truly a leap forward because it shows many of these seemingly irrational market behaviors might actually be consistent with rational economic principles.
Exactly right. The investment CAPM provides this unified framework. It turns out most anomalies seem to be different ways the investment and profitability premiums show up.
Okay, how so?
For instance, the investment factor, IA. It's mainly responsible for capturing the value minus growth anomalies and other investment-related patterns. Think about it.
Yeah.
Value firms, low valuation ratios, they tend to invest less. The model predicts they should earn higher returns.
Right.
Growth firms, high valuation ratios, they invest more. The model predicts they should earn lower returns. This fundamentally reinterprets the value premium. It's not just about the book-to-market ratio itself, but it's an investment premium driven by underlying corporate decisions.
So value is really just low investment in disguise, according to this model.
Largely, yes. And it also helps explain things like asset growth. Companies growing assets quickly tend to underperform. Equity issuance, companies issuing stock tend to underperform. And even long-term reversal, all linking back to how firms manage their capital and investment.
Okay, that covers the investment side. And the ROE factor, the profitability one, how does that fit into explaining anomalies?
The ROE factor is primarily connected to price and earnings momentum. Firms that have recently had positive earnings surprises tend to be more profitable, right? Higher expected profitability.
Makes sense.
The ICPM predicts such firms should earn higher returns, which is perfectly consistent with what we see in momentum. It's the profitability driving those higher subsequent returns. Similarly, it helps account for the distress anomaly. Less profitable firms tend to earn lower returns.
So momentum is linked to profitability shocks?
That's the main driver, yes. And even anomalies related to things like intangibles or trading frictions can often be explained by a combination of both the investment and profitability factors. Shows the framework is pretty broad.
Here's where it gets really interesting for me. The investment CAPM gives us this unified, coherent explanation. So many of these seemingly unrelated puzzles value, momentum, asset growth, They might just be different faces of the same underlying economic forces. Rational decisions about investment and profitability.
That's the beauty of it.
Not necessarily investor weirdness. It gives a rational neoclassical foundation to what often seemed inexplicable or irrational before.
Exactly. It brings this sense of order and deep economic logic to what looked like market chaos from the perspective of the older models. It really is a foundational shift.
Now, this impressive performance of the Q-factor model, it naturally led to a significant, well, factors war, as our source puts it. When something new and powerful comes along, the established players have to react, right?
Oh, absolutely.
And Fama and French, the giants in factor modeling, they certainly did react.
They did. Fama and French, in their 2015 paper, introduced their own 5-factor model. They essentially added their own versions of investment and profitability factors to their original 3-factor model. They called their investment factor CMA, conservative minus aggressive, and their profitability factor RMW, robust minus weak. And this move, adding these types of factors, was seen by many as a kind of endorsement, really, of the core insights from the investment CAPM.
An implicit nod, maybe.
You could say that.
Yeah.
They motivated it using the Miller and Modigliani valuation theory, which does suggest links between book-to-market profitability, investment, and expected returns.
So they adapted, which makes sense when you see new evidence. But then the Q-factor proponents, Hu, Zhu, and Zhang, they had their own counter-critique, didn't they? It wasn't just about adding factors, it's about which model was truly superior and maybe more fundamentally grounded.
Indeed. Hu, Zhu, and Zhang didn't just rest on their laurels. In follow-up work in 2016 and 2017, they ran rigorous factor spanning tests. Basically, they tested if one model's factors could explain the returns of the other model's factors.
Okay, a head-to-head comparison.
Exactly. And the results were pretty stark. They found that the Q-factor model could explain Fama French's HML value, RMW profitability, and CMA investment factors with tiny alphas, meaning the Q factors basically captured everything those other factors were doing.
So the Q model subsumed the Fama French factors.
Essentially, yes. It suggested that RMW and CMA might just be noisy versions of the more economically grounded Q factors, ROE and IA. But crucially, the reverse wasn't true. The Fama French 5-factor model could not explain the Q factors nearly as well. The alphas were much larger, suggesting the Q factors captured unique information that FF5 missed.
That's a big deal. It points to a fundamental difference in explanatory power.
It does. And another really interesting point came out regarding the value factor, HML. The IKPM theory implies that the value premium is really just a manifestation of the investment effect.
Right, we discussed that.
So if you have a good investment factor, like IA, the HML factor should become redundant. And guess what Fama and French themselves found in their 2015 paper when they added RMW and CMA?
Let me guess. HML became redundant.
Exactly. They found HML didn't add much explanatory power once the other two were in, which, perhaps ironically, provided strong empirical support for the ICBM's theoretical view on value, a powerful confirmation from an unexpected corner.
That's fascinating. But there were also some criticisms aimed directly at how Fama and French constructed their investment factor, CMA. What were the issues there?
Yeah, there were a couple of key points. First, the theoretical motivation. Fama and French linked CMA to a negative relationship between expected investment and the internal rate of return. But the ICAPM, when derived from first principles using the valuation equation, suggests more of a positive relationship between the expected stock return, the discount rate, and expected investment.
A subtle but important theoretical difference.
All right, and perhaps more critically, from an empirical standpoint, Fama and French use past investment to proxy for expected future investment when building CMA.
Is that a problem?
Well, research, including work by Hu et al., showed that how much a company invested last year, or even the year before, is actually a terrible predictor of how much it will invest, say, 4 years down the line.
Yeah.
Past investment just doesn't persist much at the company level.
Ah, so using past investment to predict future investment is like driving by looking only in the rearview mirror?
Kind of, yeah. It makes CMA a potentially poor forecast of the expected investment that actually matters for the theory, weakening its foundation compared to the Q factors IA measure, which uses more concurrent asset growth.
Okay, so issues with the investment factor. And the debate even got into the weeds on profitability. It wasn't just if profitability mattered, but which ROE factor. It sounds like measurement details were crucial here, too.
Absolutely critical. This was another major point of contention. Fama and French, back in 2006 and 2008, had initially found only a weak, insignificant profitability premium using their own earnings measures.
Right.
Then Robert Novimarks came along in 2013, proposed using gross profits to assets, and found a significant premium. Fama and French subsequently used a version of this to build their RMW factor.
Okay, so gross profits seem to work better.
It seemed to. However, Hu et al. Dug deeper and found something really interesting. They demonstrated that Novi Marx's specific measure gross profits divided by current assets was, in their words, contaminated by a hidden investment effect.
Contaminated? How? That sounds subtle.
Think about it. Gross profits are generated by the assets the company had in place before the current period,
Yeah,
right?
that makes sense.
So economically, it makes more sense to scale profits by lagged assets, the assets from the previous period. When Hu et al. Did that, scaling gross profits by one-year lagged assets, the annual profitability effect largely disappears.
Wow, so the original measure was partly picking up asset growth, which is an investment effect.
Exactly, because current assets include recent investment. So what looked like a pure profitability premium was partly an investment effect in disguise. It just shows how crucial precise factor construction, guided by economic theory, really is.
The devil is truly in the details. It's like finding a key ingredient was mislabeled in the recipe, throwing off the whole dish.
That's a good analogy. And just to add another layer, Huetta also showed that while annual sorts using earnings had issues, if you did monthly sorts based on the latest quarterly earnings to lagged assets, like their ROE factor or ROA, you actually found a robust profitability premium. In that monthly context, ROE even outperformed gross profits.
So the timing and frequency matter too, not just the definition.
Immensely. The choice of deflator, what do you divide by, the timing of measurement, annual versus quarterly, the frequency of sorting, annual versus monthly. All these technical details can dramatically change the empirical results. It highlights the need for careful, theory-driven empirical work.
Man, it really is like watching a high-stakes chess match play out in finance research, but with potentially huge implications for how we understand markets. And the Q-factor model, with its strong economic roots and this meticulous construction, seems to be making some really powerful, decisive moves.
It seems that way. And crucially, this isn't just the proponents singing their own praises. Independent studies have largely backed up the Q-factor model's superiority.
Like who?
Researchers like Barillas and Shankin, for instance, use Bayesian methods, a different statistical approach, to compare models head-to-head. They reported overwhelming probabilities, something like 97% in favor of the Q-factor model versus only 3% for the Fama-French 5-factor model, when explaining a broad set of anomalies.
97-3, that's pretty decisive.
Very. And Stambaugh and Yuan, in another independent study, also confirmed that the Q-factor model seems to explain the Fama-French 5-factor returns, but not the other way around. And they found it did a better job explaining a wide array of anomalies. So this growing body of external evidence really solidified its position as a leading contender.
It really sounds like the evidence is piling up not just for the Q-factor model's empirical power, but also for the fundamental economic intuition behind the investment CAPM itself.
It does. And it really underscores the power of deriving these factors from fundamental economic theory, the firm's investment decisions, rather than just, finding patterns in the data and building factors around them. It's a return to first principles that seems to have profound practical payoffs.
It's fascinating, isn't it, how in finance we sometimes chase the latest thing, forgetting that some of the most profound ideas have really deep, even ancient intellectual roots. The investment CAPM seems like a perfect example of that. It didn't just materialize recently.
Not at all. Its intellectual lineage goes back way further than most people realize. You can trace threads back over a century to economists like Boom Bawerk in 1891.
Boom Bawerk, what was his contribution?
He talked about roundabout production. It's the idea that more time-consuming, indirect methods of production ones that require more capital investment upfront tend to be more productive in the long run. This implies a sort of negative relationship between real investment and the discount rate. If interest rates are low, it makes sense to undertake these longer, more capital-intensive projects.
So more complex, longer-term production needing more investment is linked to lower discount rates, lower expected returns to be economically viable. That sounds remarkably close to the ICPM's investment premium logic, even back then.
Absolutely. And then Irving Fisher, in his famous 1930 book, The Theory of Interest, really formalized these ideas. He built the first sort of general equilibrium model that explicitly integrated intertemporal exchange trading consumption across time with production.
Okay.
He introduced the concept of investment opportunity as a fundamental determinant of the interest rate, right alongside impatience or consumption preferences. And crucially, Fisher's work also gave us the Fisher separation theorem.
Remind me what that says.
It basically showed that a firm's goal of maximizing its present value making, the best investment decisions, could be justified independently of the specific preferences of its individual shareholders. The optimal investment rule depends on the market interest rate, which itself is determined by the available production technology, not just by how investors feel about consumption.
That's huge. It means you can analyze the firm's optimal decisions on their own terms, separating them from the maybe messy world of individual investor desires. That really clears the path for a firm-centric view, doesn't it?
It really does.
Yeah.
And perhaps one of the most direct yet often overlooked ancestors in modern finance comes from Lodigliani and Miller's work in 1958. Everyone knows Propositions I and II about capital structure irrelevance,
Right, the MM theorems.
but their Proposition 3 is often forgotten. It explicitly stated that a firm, acting in its stockholders' best interest, should take an investment opportunity if, and only if, the rate of return on that investment is at least as large as its cost of capital.
That sounds exactly like the NPV rule guiding the ICPM.
It basically is. It directly links optimal investment decisions to the firm's cost of capital, and therefore to expected returns. You could argue it's the earliest clear statement of the investment CAPM idea in modern finance literature.
Amazing. And then, jumping forward quite a bit, John Cochrane in 1991 really revived this Q theory perspective in the modern asset pricing discussion, right? Setting the stage for its current resurgence.
He absolutely did. Cochrane was the first in the modern era to explicitly apply Tobin's Q theory, the ratio of market value, to replacement cost to asset prices. He argued that investment returns should equal stock returns in equilibrium. He articulated how a production-based model connects asset returns to the marginal rate of transformation, how efficiently firms can turn foregone consumption today into future output inferred from investment data. It was a critical step in bringing the firm's production side back into the asset pricing conversation.
Okay, so given these deep historical roots, Boomberg, Fisher, MM, Cochrane, and how foundational these ideas seem, why did the field largely overlook this crucial supply-side perspective for so long? It feels like it was there all along.
That is the big question, isn't it? And the maybe unfortunate truth is that for decades, modern asset pricing theory just became overwhelmingly dominated by the investor's demand side.
Yeah.
The focus shifted almost entirely to models like Markovitz's portfolio theory, the original CAPM, and then the consumption CAPM. Early pioneers in asset pricing like Robert Merton and Douglas Breeden actually made an explicit choice to abstract away from firms' production and investment decisions in their seminal models.
Why would they do that?
They essentially viewed the supply side, the production side, as too complex, too messy, maybe harder to model empirically at the time. So they focused on deriving the demands for assets based on investor behavior, effectively treating the supply of assets or the characteristics of firms as given, or exogenous.
So they made a deliberate simplification, maybe a necessary one at the time, to make progress. But in hindsight, it cut out half the picture, and maybe the more empirically useful half, as it turns out.
You could certainly argue that. This abstraction, while it made those initial models more tractable, ultimately proved to be a major weakness when they were confronted with real-world data and that growing pile of market anomalies. The field basically entered this long period of oblivion for the supply side in asset pricing theory.
But the investment CAPM didn't stay buried in oblivion, did it? It experienced this reincarnation, as Zhang calls it. It sounds almost like an inevitable comeback.
Yes, and Zhang argues it was an inevitable response. It was almost forced by the persistent empirical failures of the consumption CAPM and the sheer weight of the anomalies literature that kept challenging the standard efficient market story.
The data just kept screaming for a better explanation.
Exactly. So the ICPM's reemergence, championed by researchers like Zhang himself, starting with his 2005 work and building on Cochrane's earlier insights, offered a desperately needed neoclassical framework. It could explain these weird patterns without having to assume investors were irrational. That's why it's called an efficient markets counter-revolution to behavioral finance.
So it brought asset pricing back into a framework where you could explain these patterns through rational, optimizing behavior, just from the firm's perspective this time. It filled a huge void left by the consumption CAPM.
Precisely. It represents a symmetric way of looking at the general equilibrium asset pricing problem. Just like the consumption CAPM focused on consumption smoothing and investor utility functions, the ICAPM focuses on firm characteristics of production technologies. It filled a conceptual gap that had been largely ignored for far too long, offering a more balanced view that incorporates both the demand and supply sides of the economy.
We've covered the history, the theory. But the real acid test is how well it explains the messy world we actually live in. And this seems to be where the investment CAPM really shines, offering some profound insights into why financial markets behave the way they do.
Absolutely. And one of the most critical conceptual points the ICPM brings back to the forefront is Alfred Marshall's famous scissors analogy from way back in 1890.
Ah, yes, the two blades.
Right. Just like you need both blades of a pair of scissors to cut paper, you need both demand, driven by consumption preferences, and supply, driven by investment decisions, to determine equilibrium asset prices. The ICPM emphasizes that in the grand scheme, in general equilibrium, things like consumption betas, expected returns, and firm characteristics like investment and profitability are all endogenous.
Meaning they're all determined simultaneously within the system.
Exactly. They influence each other. No single factor simply causes the others in a straight line. This directly challenges that common and often misleading textbook idea that risk, measured by beta, causes expected returns.
So it's not a simple A causes B chicken and egg thing. It's more like a complex web where everything is evolving together to reach an equilibrium. That's a big shift in perspective for a lot of people, I think.
It really is. It's a more holistic view.
Yeah.
And if we think about why the consumption CAPM struggles so much empirically, the aggregation critique is maybe its most devastating flaw.
Aggregation, meaning adding up individual behavior.
Yes. The consumption CAPM relies heavily on the idea of a representative consumer, one single agent who stands in for the entire economy. But this concept runs headfirst into a major theoretical roadblock, the Sonnenschein-Mantel-Debreu theorem.
Okay, what does that theorem say?
Basically, it proves that even if every single individual person in the economy is perfectly rational with well-behaved preferences, when you add up their demands, the aggregate demand curve doesn't necessarily have to look rational or well-behaved at all. It can wiggle around in all sorts of ways.
Whoa. So the idea that, all 330 million Americans or 1.4 billion Chinese act as one single representative consumer with perfect, consistent preferences is maybe not the strongest foundation for a model. That's a huge aha moment. It kind of undermines that whole approach.
It really does. Prominent economists like Alan Kierman have argued quite forcefully that the representative agent concept deserves a decent burial, calling it fundamentally erroneous. Angus Deaton also highlighted the absurdity of these aggregation assumptions. The consumption CAPM, being fundamentally macroeconomic, relying on this aggregate consumer, is just ill-suited to explain the micro-level, firm-specific anomalies we see in stock returns.
But the investment CAPM, being based on the firm, avoids this aggregation trap.
It does, largely. The ICAPM is relatively immune to this critique because it's derived from the first principles of an individual firm's optimizing behavior. It's inherently microeconomic. It starts from the ground up with individual rational agents, in this case, firms making investment decisions, making it a much more suitable framework for explaining the cross-section of returns and those firm-level anomalies that have puzzled finance for so long.
Okay, so that's a big theoretical advantage. Beyond aggregation, there's also the practical issue of just measuring things accurately, right? Particularly betas. That's been a huge challenge for many models historically.
That's another critical point, yes. The consumption CAPM faced enormous practical difficulties just measuring consumption accurately. The data is often noisy, it's measured infrequently, monthly or quarterly, when the theory requires something closer to instantaneous consumption, and the sensitivity of stocks to consumption beta, likely changes over time.
So garbage in, garbage out, potentially?
Potentially, yes. These measurement errors severely undermine empirical tests. And it's not just the CCAPM. The classic CAPM also suffers from severe beta measurement errors. People like Miller and Scholes pointed this out way back in the 70s. More recent work by Lin and Zhang and others shows these errors can make it incredibly difficult to detect the true relationship between risk and return, often causing firm characteristics like size or value to look more important empirically, even if the underlying economy is perfectly rational and driven by beta risk.
So even if the theory is right, our measurement tools might be so blunt that they obscure the signal. That really clears the deck for a different approach, showing why focusing on more easily observable firm characteristics like investment and profitability can be so powerful empirically.
And that different perspective is the investment CAPM's ultimate contribution. It's an efficient market's counter-revolution to behavioral finance. The core message is this: asset pricing anomalies aren't necessarily signs of irrational mispricing or weird psychological biases. Instead, they can be entirely consistent with rational economic principles embedded in the fundamental investment and profitability decisions that firms make.
That's a direct challenge to a lot of the behavioral stories. I mean, if investors are supposedly so prone to biases like overconfidence or conservatism, why would corporate managers who come from the same human population suddenly be perfectly rational when making huge, real investment decisions? That's a tricky point for behavioral finance, isn't it?
It's a very powerful point. The ITPM provides a coherent, rational framework that applies to the firm. If anomalies really stem from deep-seated psychological biases, as suggested by studies like Barbaros et al. Or Daniel et al., it's hard to explain why managers making multi-million-dollar investment choices wouldn't be subject to similar biases. The ICPM simply doesn't need to invoke investor irrationality. The rational decisions of firms are enough. It's more parsimonious.
And then there's the crucial international evidence. This really seems to throw a wrench into the standard behavioral narrative, doesn't it? This is where the rubber really meets the road globally.
This is a particularly compelling piece of the puzzle. Numerous studies looking at global financial data have consistently found that key anomalies, like the investment effect and especially price momentum, are actually stronger in developed, presumably more efficient markets than they are in emerging markets.
Stronger in developed markets,
Yes.
like the US and Europe.
Exactly. For instance, momentum profits in the U.S. average around 0.79% per month, according to the data cited. In China, a major emerging market, they're only about 0.26% per month. That's a massive difference.
That is a huge difference. And this flatly contradicts what standard behavioral finance would predict, right?
It's an emphatic contradiction. The standard behavioral story is that anomalies should be stronger where markets are less efficient, like in emerging markets. Why? Because investors there might be less sophisticated, information flows less freely, and importantly, limits to arbitrage are more severe. It should be harder for smart money to correct mispricing.
So behavioral finance predicts bigger anomalies in emerging markets, but we see the opposite.
We see the opposite. Momentum, often considered a prime example of behavioral bias, is significantly weaker in emerging markets and stronger in developed ones.
So if momentum, a behavioral stronghold, is actually stronger in highly efficient markets like the US, what does that tell us about its true nature? It sounds like a powerful rejection of some key behavioral predictions.
It strongly supports the investment CAPM perspective. The ICAPM predicts that these anomaly patterns, driven by rational firm investment, should be stronger, where managers' incentives are well aligned with maximizing shareholder value, which is generally more true in developed markets with strong corporate governance.
How?
In emerging markets, managers might face different incentives, maybe political goals or weaker governance, leading them to make investment decisions less tightly linked to maximizing market value, thus weakening the resulting anomalies. The empirical evidence lines up perfectly with this IKPM prediction and contradicts the behavioral one.
And that limits to arbitrage argument, which behavioral finance uses to explain why mispricing can persist. How does that fit with this international evidence?
It fits poorly for the behavioral view. Limits to arbitrage like short-selling costs or noise trader risk are generally considered more severe in emerging markets.
Yeah.
According to behavioral finance, this should allow more mispricing and thus stronger anomalies to persist there. But again, the data shows anomalies are weaker there. It's another direct contradiction.
This pattern is really hard to reconcile with a purely behavioral explanation for these anomalies.
Very hard. And what this means, going back to theory, is that the investment CAPM also helps alleviate that famous joint hypothesis problem that Eugene Fama highlighted back in 1970.
Remind us of that problem.
The problem is that you can never test market efficiency in isolation. You always have to test it jointly with the specific asset pricing model. So if you find evidence that seems to contradict efficiency, like an anomaly, you don't know if the market is truly inefficient or if you just used a bad model of expected returns.
The model could be wrong, not the market.
Exactly. The IKPM provides a robust, rational equilibrium model. By showing that many anomalies are consistent with market efficiency when viewed through this lens of rational firm behavior, it helps disentangle that ambiguity. It suggests maybe the market wasn't inefficient. Maybe our previous models were just incomplete.
And it broadens our understanding of efficient markets beyond just the old risk doctrine, right? That seems like a crucial evolution in thinking.
Absolutely. The IKPM expands the efficient markets hypothesis beyond that narrow, older focus where risk, usually measured by beta, was seen as the sole determinant of expected returns. It demonstrates powerfully that characteristics like investment, IA, and profitability, ROE, derived directly from fundamental firm decisions, are just as important, if not more empirically relevant, than traditional risk exposures in explaining expected returns within a rational framework.
So the old idea that only risk determines expected returns is maybe too simplistic.
It seems so. That idea, as Zhang argues, is really a relic of older, incomplete models like the classic CAPM, which basically assumed stock returns and their covariances were just given exogenous inputs. The investment CAPM shows us a richer picture where risks, expected returns, and firm characteristics are all intertwined, all endogenously determined components of a complex but ultimately rational economic equilibrium involving both investors and firms.
Wow. This has been a truly illuminating deep dive into the investment CAPM. It's really clear that this framework offers a powerful neoclassical lens for understanding asset prices, one that's derived directly from the rational investment and profitability decisions of firms themselves. It successfully explains so many of these market anomalies that just completely stumped previous models, and in doing that, it really challenges some of the core tenets of behavioral finance. We've seen this shift from a purely demand-side view of asset pricing to a much more integrated understanding, bringing both demand and supply together to determine prices.
A more complete picture.
For many years, it felt like the debate was kind of stuck, between an elegant but empirically failing rational model and a more descriptive behavioral model that maybe lacked the same theoretical rigor. This deep dive has shown us how the investment CAPM really bridges that gap. It offers an elegant, rational explanation that also holds up incredibly well in the data.
It really does seem to check both boxes.
It truly provides those aha moments about why stocks behave the way they do. It moves us beyond simple, maybe binary notions of market efficiency versus inefficiency into a more nuanced, economically grounded understanding.
A much richer understanding.
So for your provocative thought to send you off with today, consider how this shifting perspective, from focusing solely on investor demand and psychology to understanding the fundamental interplay of firm investment and expected returns, might fundamentally change how you evaluate investment opportunities, or even how you interpret the daily market news. What does efficient truly mean when we fully account for the production side of the economy, the real decisions companies are making? And how might this guide your own decisions? Perhaps it encourages you to look more deeply into the real-world investment plans and the underlying profitability of the companies you analyze, rather than just chasing market sentiment or relying solely on past price patterns. Something to think about.
Definitely food for thought.
That's all for this deep dive. Join us next time as we continue to unpack the most compelling ideas shaping our world.